Hello and a very warm welcome to our first investment outlook of 2020. Now, with a new year and a new decade ahead of us, not to mention a lot going on in world markets today, I'm delighted to introduce Tom Stevenson, Investment Director here at Fidelity, who's with us to shed some light on what we should and perhaps shouldn't be focusing on as investors. Afternoon, Tom.
Hi, Emily.
Now, these continue to be uncertain times. You're looking 12 months ahead. How difficult is that to do in the current climate?
Well, it's always quite difficult to look into. Predictions are always hard or unadvisable, especially ones about the future, they say, don't they? But no, this is a new decade, a new year, a new decade, so lots to think about in the market. It's very exciting. Okay,
so can you give us a quick sort of rundown on how you put the report together?
Yeah, so do it every 3 months. It's a quarterly report. I speak to many of our colleagues here at Fidelity and also gather information from external sources as well, put it all together, write the report, and then we have this webcast, which I'm really enjoying this webcast now. We're getting more and more people dialing in. It's becoming increasingly popular and people really like it, so that's great.
Okay, we should also add that this is guidance and not to be taken as.
Yeah, I mean that's a good point to make. You know, these are my thoughts on the markets. I hope that they're useful for people when they come to be selecting their investments, but it's not advice that's relevant to anyone's personal circumstances. If that's what you want, you need to speak to an advisor.
Okay, thank you, Tom. Now we're about to hear Tom's analysis of the global markets and the key asset classes over the next 12 months, but this is also an opportunity to put all those questions you have directly to him. If you haven't submitted yours yet, there's still plenty of time. Just click on the top right-hand corner of the screen where you'll see 3 horizontal lines. Click on those and a drop-down box will appear, which will let you send us your questions. Now, just before we go into the Q&A session, let's hear Tom's views on the current outlook for investors.
We head into 2020 on the back of a stellar 2019 in the markets, a year which also brought to an end a remarkable decade for investors. 2019 started with sentiment at rock bottom as stock markets focused on weak growth and rising interest rates. By the middle of the year, the outlook was improving as trade tensions eased and the Fed cut rates 3 times. Shares ended the year 25% higher, with Wall Street once again leading the pack. As the chart here shows, it was the best year in the last 7, although flattered somewhat by the low starting point. With 2018 having been the worst year in the period, the performance over 2 years was less exciting outside the US. As this chart shows, the American market was the most consistent performer throughout the year. China bounced back initially from its poor showing in 2018. Japan came from behind in the final few months of the year, and the FTSE 100 was the laggard as political uncertainty dominated. It wasn't just shares that did well last year. Even before last week's Middle East tensions flared, oil had a good year as OPEC cut back on production. Falling interest rates helped bond markets continue their long-running bull market, and precious metals rose too, confirmation that there was plenty to worry about despite the market rally. A remarkable feature of the strong rise in markets over the past 10 years has been the lack of real belief from investors. This measure of sentiment shows that US investors are neither particularly bullish nor bearish at the moment. Proof positive, I suppose, that bull markets do climb a wall of worry. The lack of exuberance is reflected in valuations, which the US accepted are not significantly higher than they have been throughout the post-crisis era. Even Wall Street is a long way off the valuation highs which have marked earlier market peaks. This chart shows why valuations have remained within reasonable parameters. Growth has been steady for years now, enabling companies to keep growing their earnings and keeping the PE ratio in check. Now, my fund recommendations from a year ago did as well as might be expected against such a strong market backdrop. The Select 50 Balance Fund delivered double-digit growth, which is more than acceptable from a fund designed to even out the ups and downs of the market with a spread of bonds and equities. Meanwhile, the 3 equity funds all rose by about a fifth, matching or beating their respective markets. So we enter a new decade with possibly lower expectations. It would be unreasonable to expect another 10 years like the last, although far from impossible. Remember, the bull market from 1982 to 2000 ran a lot longer than the one we're currently enjoying. The world will no doubt change a great deal in the years ahead. Demographic change is bound to be a big factor as populations age and spending patterns change. Climate change is now firmly on the agenda for investors, and technology too will be a major influence, as it has been over the past 10 years. And we won't be able to ignore the reversal of the past 40 years of globalization as we move into a more nationalistic, protectionist world, perhaps one in which inflation returns to be a factor after years in abeyance. So, looking at the main asset classes now, shares should continue to be the asset class of choice this year, despite last year's strong run. A soft landing for the economy and the political imperatives of November's election should provide a supportive backdrop. Valuations are not excessive, with markets outside the US only recently exceeding their dot-com highs. And they could yet go higher. Fiscal stimulus is likely to take over from interest rate policy as the main tool to stimulate economic growth. Of course, there are things to worry about. Geopolitical risk has recently reared its ugly head again. Politics will be a big feature in Washington, of course, but here too, as we negotiate a tricky trade deal with Europe. But overall, there's no reason to think that the bull market needs to end just yet, least of all the coincidental fact that the turn of the decade has often been a watershed for investors. Now, I'm a lot less keen on bonds than shares. Yes, they've been a good source of diversification, but yields are too low and I don't see them going any lower. The economy is too strong for that, and fiscal spending makes a bond-unfriendly return of inflation a real possibility. The Fed has indicated that it's happy for consumer prices to rise a bit above target to make up for years of undershooting. As for corporate bonds, well, the risk premium over and above government paper looks too thin for this late stage in the economic cycle, when default risks naturally rise. The chart here shows the spread narrowing in most countries. Much the same could be said of commercial property, where yields offer too little compensation for the risks involved. That's especially the case now that climate change is high on the agenda. Buildings account for 40% of carbon emissions, and property owners will bear the cost of upgrading their portfolios. Demand is not great either, as shown here for offices in the UK. Commodities are a tougher call. Oil has traded in a range for a long while now, although this week has seen the price of Brent crude rise above $70 for the first time in 3 months. Much depends on whether geopolitical risks can be contained. That's the wild card in an otherwise balanced environment for supply and demand. As for gold, as you can see, the price has been rising for some time now, and this week the price broke to a new 7-year high as its safe haven status came to the fore in the wake of higher tensions in the Middle East. So, if shares are the place to be, which markets look best in 2020? Probably not the US if valuations are a guide. The grey bands here show relative overvaluation in recent years, although it's also clear that shares are not as expensive as they were 20 years ago. Wall Street looks to have factored in more good news than other markets, but it remains well below its dot-com peak. There's plenty of uncertainty over the pond, with Donald Trump potentially freed up by re-election to pursue a harder line with China, and the Democrats lining up a less business-friendly agenda too. However, I can't turn outright negative on the US. Betting against Uncle Sam is rarely a good idea, and the final stage of a bull market is usually a continuation of existing themes and trends and not a change of direction. Don't count against the US and technology stocks in particular being the focus in the market's endgame. Here in the UK, there's more clarity than there was before the election, but still plenty that remains uncertain in the run-up to December's end of the Brexit implementation period. Negotiating a trade deal in 11 months won't be easy. That said, the UK is out of favour and so cheap. With earnings outpacing inflation, again, as shown here, the domestic economy is not in bad shape and smaller shares could outperform. Japan has its moment in the sun this year with its first Olympics since 1964. The Nikkei bounced back last year but did no more than recover 2018's lost ground, and it remains cheap by international standards. Now, Japan is a cyclical economy, which is why electrical machinery has done so well recently, shown here, and will do well again if global trade picks up. Picking the right sectors matters. Longer term, the country has major demographic challenges, but in the short term, there are plenty of positives. Rising trade will also help Europe, which has massively underperformed the US, as this chart shows. Actually, things are not as bad as they look at first sight in Europe. Strip out the automotive sector, which has suffered from lower Chinese demand, and the economic picture is okay. If European governments can be prodded by new ECB boss Christine Lagarde into spending a bit more, then fiscal policy could provide a boost. And finally, the outlook is much improved for Asia and emerging markets. Easing trade tensions, despite the yawning trade gap, which is shown here, and a falling dollar could give the region a boost. Valuations are notably low, arguably the lowest relative to the developed world since the Asian currency crisis of more than 20 years ago. Corporate reforms are another positive, adding to the ongoing secular growth story as the region's middle class expands.
Welcome back. Now, Tom's poised, ready to answer your questions, so keep them coming in. Just click on the tab on the top right of the screen and follow the instructions. Okay, should we get started?
Yeah, let's do that.
Now, lots of questions, as you might expect here, on tensions in the Middle East and what the situation is, what might it escalate into, but what that means crucially for us as investors.
Yes, I mean, it almost seems wrong, doesn't it, thinking about what does this mean as investors when, you know, something as serious as that is happening. But, you know, it does matter. And I look back over my career. I started writing about the stock market in 1989. And the following year, of course, we had, you know, the first Gulf War. So problems in the Middle East seem to have sort of bookended, you know, my career. They've been going on for the last 30 years. So what are the issues? I mean, obviously, it's impacted the oil price initially. What I thought was interesting, though, was the oil price shot up, as you would expect, but very quickly, as soon as it became clear that, you know, maybe everyone was sitting back and, you know, being a bit calm about it, the oil price came back quickly. So that tells me that the oil price is roughly in the right range as it is. The gold price, of course, went up a bit. That's a sign of anxiety. And stock markets fell a bit. But again, as with the oil price, they bounced back quite quickly. So that, to me, says that the fundamental strengths of the stock market are actually quite good at the moment. So we'll see what happens with this. Obviously, if things get nasty and the oil price spikes higher, then that's going to have a negative impact on economic growth and therefore the stock market. But it's early days yet. Okay.
Now, closer to home, obviously you've got some political issues going on here, budget up ahead and things like that. Question here from Jonathan. It says, is the Boris majority government good news for UK shares or not?
Yeah, good question. I mean, I think, you know, what we had the election last month and it delivered a clear Conservative majority for the first time in a long while. So that creates more stability, less uncertainty in the markets, I think. What is almost certain is that at the end of this month, Britain will leave the EU. I can't see what would stop that happening. Unfortunately, that doesn't clear things up completely, because what that sets in train is 11 months of very tough negotiations between Britain and the rest of the EU over our trading relationship. And 11 months might sound like a long time. It's a very short time when it comes to trade negotiations. The negotiations between Canada and the EU, for example, took many years to come to a deal. So I think the danger is that we end up with a very bare bones, rather thin trading deal, which is not necessarily good news for the UK economy. The alternative is that the government actually goes back on what it said and actually seeks an extension, because we can extend this process for another 2 years after the end of this year. The moment that looks quite unlikely. The more likely option, I think, is that we do get a deal, but it's quite a thin trade-only deal. Okay, so in terms of UK investing then, Malcolm Brickwood asked the question, what are your current thoughts on how much of your portfolio should be invested in the UK then for someone who maybe has like a higher risk tolerance? Yes, I mean we've thought about this question many times over the last year or so, because clearly a lot of investors do have a bit of home bias in their portfolios. They're investing in the UK, they understand the UK market, they're familiar with UK companies and funds. They tend to have more than you would necessarily think is the right amount in the UK market. There is a good reason to invest in the UK market at the moment, and that is that it's pretty cheap. Because it's been out of favour for so long, really ever since the EU referendum in 2016, the market has got progressively cheaper in the UK, and that's happened at a time when other markets, I'm thinking particularly about the US, has got more and more expensive. So I think there's a valuation argument for investing in the UK. We do have more certainty, so that's a positive, and we saw markets bounce a bit after the election, but there's still a lot of uncertainty. So I think getting that balance right is quite a challenge at the moment. Okay, a lot of questions as well, obviously, on the forthcoming budget coming up in 11th of March. Question there, what do you expect to come out of that? Well, I think the interesting thing that's happened in UK politics at the moment is, of course, that the majority has been achieved for the Conservatives on the back of many voters from parts of the country which are not natural Conservative supporters. So, Boris Johnson, the Prime Minister, said it in his own words. He's aware that many votes have been lent to the Conservatives rather than given to the Conservatives. And so in order to keep those votes at the next election, I think that the government needs to deliver to these new Conservative voters. And part of that means spending, increasing spending on things that matter to people, things like the NHS, schools, security, the police, those kinds of things. So I would expect that this budget will be the first instalment in that increase in sort of fiscal spending, fiscal stimulus. And this is not just happening in the UK, of course, this is happening globally. This move towards a more nationalist, protectionist, populist type of politics is going to encourage more spending, I think, and so we're going to start to see that in the budget. Okay, now this is interesting as well this time, lots and lots of questions on ESG, sustainability and things like that. A couple of questions here. Lindsay West says, in your review of the year ahead, how important are ESG issues? Are asset values going to be affected by climate change and likely related policy change? Yes, I think one of the really interesting things about the last year or so is that a focus on ESG, environmental, social and governance factors in investing has really taken off. And so that question asked specifically about risks, and I think this is the key part of ESG, because what an ESG analysis really focuses on is financial risks to do with climate change, to do with companies not behaving in the right way, whether that's environmentally or socially or from a governance perspective. And I think that many investors, particularly big professional investors, are taking these risks very seriously, because at the extreme, an oil company, for example, simply might not be around in 5 or 10 years' time if policy changes and if spending patterns change. And so, it is a very real concern for investors. They need to focus on these things. Okay. Sharon Byfield here has just made a comment. She says, I welcome Fidelity's launch of new sustainable funds. Is it possible to have even more choice in this area, as I'm concerned about climate change? It's obviously a burning issue for many people. I think for many people it is a really important issue, and people want to do the right thing. And there are two sides to looking at ESG. One is this financial risk question, and the other is people just wanting to do the right thing with their money. And I think that we see a lot of funds which purport to be investing in this way. What we don't have at the moment, and I think this is quite confusing for investors, is we don't really have an agreed set of definitions of what sustainable investing is all about. And I think from an industry perspective, from our perspective also as a platform, we need to really get our heads around what these standards might be so that we can help people in a clearer way in determining which funds they should be investing in if that's important to them.
Okay, yeah, Taha asks exactly that. He says, social responsible investing, have you got any good ideas to start off with?
Yeah, so I mean, you know, there are many funds in this area, and I think that one of the things which, you know, I would like to say that we're going to be really focusing on from our perspective this year is working out just how we can present those funds in the most useful, informative way for our investors. So watch this space.
Okay, question here from Stephen. Would it be a good idea to invest in infrastructure, and who would you suggest?
Well, I mean, so I mentioned earlier on about fiscal spending, increase in stimulus, governments spending money on the things that matter to people. Well, one of the things that really matters to people in this country, for example, is transport. And we know that there is a huge difference in the amount of money that's been spent on infrastructure in the southeast of the country compared to the north, for example. So one of the things which may well come out in the budget in March is more spending on transport infrastructure in the north of England, for example. So I think that there are lots of reasons why infrastructure is a sensible place to focus. And it's again, not just in the UK, the world over. You look at the US, the infrastructure in the US largely put in place in the Victorian era or in the early part of the 20th century. It's just becoming old and broken down. A lot of money the world over needs to be spent on infrastructure. So as a place to focus on for investment, absolutely a good idea. In our Select 50, we have a new fund just in the last few months brought onto the Select 50, a Foresight Infrastructure Income Fund. So that might be a good place to start.
Good idea. Okay, now Ray says, thanks for a very interesting webinar so far. Thank you, Ray. One has to diversify when investing, and one would typically invest in both equities and fixed income in different proportions according to your risk profile. However, there might be a dilemma here given your outlook about bonds with yields being at all-time lows. What would you recommend in such a scenario without exposing yourself to too much risk?
Yes, I think that's a good question because you know, if I sort of characterised my my outlook this quarter, very much I've swung back towards shares. I think that is the asset class of choice at the moment because I see a bounce back in growth, largely partly on the back of the interest rate cuts last year, a sort of easing of trade tensions. So I think that the outlook for the economy is quite good. On the other hand, on the bond side of things, I think that yields are very low, probably too low. They're not compensating investors for the risk of, for example, the return of inflation, which I think is a possibility, especially if governments start spending a lot on boosting the economy, fiscal spending. So I do think that, you know, the balance should tilt towards shares at the moment, but a well-diversified portfolio will have a balance of the two. One of our 4 funded recommendations last year and this year, actually again, is the Fidelity Select 50 Balanced Fund. I think it's a great starting point for people that want to create a balanced portfolio because it has both shares and bonds and other asset classes as well. It's geographically well diversified. So it's a very good sort of core starting point for someone who wants to get a diversified portfolio.
Okay, that's a good suggestion. But Kevin here, on the theme of diversification, says, I understand the need for diversification, but can you over-diversify? If you had a £100,000 pot, approximately how many funds should you be holding in it?
Well, it's a good question, and it's not an easy one to answer because it depends on how much diversification is built into your investments. And so if you just look at the names of the funds, for example, you might think that they're very different, they're well diversified. If you look under the bonnet at the underlying investments, you might find that many funds actually share the same investments. So I think it's a very important thing to say, have a look, underneath the surface of your funds, your investments, see what's in there and get a real picture of what the underlying diversification is. I think I would agree with the underlying premise of the question, though, that it is possible to be over diversified, and actually 10 to 12 funds may well be enough to give you sufficient diversification.
Okay. Now Priyesh here says, Tom, can you expand on your positive views for Asia and emerging markets? Which geographies do you find interesting and why?
Yes, I think emerging markets generally look quite interesting at the moment for a couple of reasons. One is that over the last 10 years or so, global stock markets have really been dominated by the performance of the US market. It's outperformed all the others. And by comparison, emerging markets look pretty cheap. The valuations in many emerging markets are way behind what they are in the US. So valuation is one argument. The second argument for emerging markets is to do with the dollar. So when the dollar weakens, that tends to be good for emerging markets. When emerging market currencies rise, it tends to reduce inflation in emerging markets and allow central banks in emerging markets to reduce interest rates, which of course stimulates their economies. And I think that looking forward with the Federal Reserve being more accommodative last year and into this year, I think the likely direction of the dollar is slightly weaker, and that means probably slightly stronger emerging market currencies, and that's good news for emerging markets.
Okay, and Jason Bonner asks, India or China?
Very, very different economies and very different issues. I think, looking at the Indian economy at the moment, there's a lot of reform going on, corporation tax cuts. India is way behind China in terms of development, in terms of growth of the manufacturing sector, for example. Investment in infrastructure there has got a long way to go. So if you're looking for a long-term investment, maybe India looks maybe more interesting than China. But there are lots of opportunities in China as well. The consumption economy in China is still growing and will continue for many years to come.
Okay, just got time for one final question, I'm afraid now. So many still coming in. Is the US too expensive now? Or will Trump pull something out of the bag to boost markets before the November election?
Well, I mean, the election is absolutely key to this year because it will influence lots of things. It's influencing, for example, what's going on in the Middle East. Of course, it will influence interest rates because the president is very keen for the central bank to be supporting the economy, so he'll be putting a lot of pressure on Jay Powell to keep interest rates low. In terms of sort of fiscal spending and support, then in the run-up to an election, often there's a lot of activity on that front. So the year leading up to an election is often quite a good year in US markets. The counter-argument, of course, is that the US, because it's done so well, and last year, up nearly 30% last year, because it's done so well, it is pretty expensive by comparison with other markets. So I'd say I'm neutral on the US market at the moment. I don't want to walk away from it because it's been so fantastic and it rarely makes sense to bet against the US, but it does feel a bit expensive at the moment.
Okay, Tom, thanks so much. I'm afraid that is all we've got time for. But thanks so much for joining us today, and apologies for the questions we couldn't answer in today's webcast. If you want to have a look at some of the insights we've talked about today, or get some more on the questions and the answers that Tom has in the Outlook, then you can actually get hold of a full copy of the report, and you can also watch Tom's presentation again, and you'll find it all in the Markets and Insights section at fidelity.co.uk. Tom, you're also going to be recording a podcast later today.
Yeah, absolutely. Yeah, Thea, thanks for mentioning that. Yeah, so I'm going to be recording a podcast with our colleague Ed Monk. I'll be exploring some of these issues in more depth and also going into my fund recommendations. So if you go onto your phone, onto your podcast app, and just search for Fidelity, it's the Money Talk Radio podcast. That's what you want to sign up for, and that podcast will be available later today.
Great. Thanks very much, Tom, and thanks for watching.